Hello and welcome back to the American Dream Portfolio. At the start of this channel, we said that pursuing the American dream by taking an ownership stake in hard-working assets would require, among other things, control over your emotions. In the next few videos, we explore 4 different emotional responses that may prompt you to sell your investment at a loss. In other words, emotions can increase your investment risk. We are often told that fear is one of the key emotions that can court disaster in the markets. There are many reasons why investors may become fearful. Some reasons are under their control and some are not. Let's look at a fairly recent example of when fear reigned supreme throughout the investment world and how it may have caused investors to sell at a loss. The year was 2020, and the shock no one expected was the COVID-19 pandemic. In addition to the tragic human toll of illness and loss of life was the economic toll of worldwide lockdowns and supply chain disruptions. The US stock market, as measured by the S&P 500, had roared through 2019 with a 31% gain. It continued confidently into 2020 until the dark clouds of COVID started to gather in mid-February. Let's take a look at the S&P 500's price chart to see what happened next. After its peak on February 19th, the index began a decline that accelerated rapidly into the 4th week of March. By this time, investors had every reason to believe the economy was headed for a severe recession, or quite possibly for a depression. While media hype is often pervasive at times like these, investor fears were not unreasonable. Countless businesses were being shuttered every day, and necessary supplies, as exemplified by toilet paper, flew off the shelves as panicked shoppers feared they might not return for months. The waterfall decline of the stock market during this period is proof that selling pressure, driven by fear, was much more intense than the tepid will to buy. Very few market participants were asking how low the market could go. Instead, they were heading for the exits. With economic catastrophe looming, the overwhelming consensus was that the market would go much lower. What may have happened to the investors who sold during this crash? We see 2 likely outcomes. In the first, let's say you sold on March 16th, in the midst of this cascading disaster. At that point, the market was already down 30% from its high, though it would go lower. Depending on when you originally purchased those shares, you may have realized an immediate loss. But what if you accumulated those shares over many years? In that case, you would have had a low enough average cost such that selling into this panic would still have given you a profit. But when would these investors have gotten back into the market? Let's continue this chart after March 23rd to see what happened next. As you can see, the S&P 500 began a vigorous, and some would say, a miraculous recovery off the March 23rd low. But every step of this recovery was fraught with apprehension, newly identified fears, and a general alarm about what the future held in store. To the question, when did investors get back into the market? We get some insight by looking at the next chart. Here we see the progress of the S&P 500 through the end of 2020. The strong uptrend that began in late March continued through year-end. In fact, it only took the market 5 months to recoup its losses. But this chart also shows daily trading volume, the pink and grey vertical bars at the bottom of the chart. Notice how high the volume was during the crash and how quickly it declined throughout the recovery. This suggests that investors who returned to the market did so in small numbers over the second half of 2020, and at prices much higher than the period of greatest decline. Therefore, while many investors who sold during the crash may have held on to gains, those who re-entered weeks and months later would have repurchased at higher, and possibly much higher prices, thus squandering their earlier gains. This fear, whether reasoned or not, prompted countless investors to lose money. Are there any lessons to be learned from this difficult time? Well, hindsight is always 20/20, but market history sheds some light on the answer. Looking at frightening declines of the past, we find that they are typically associated with a single event or with related events that take place against the backdrop of an economy that is generally sound. In the case of the 1987 crash, which had a peak-to-trough decline of 33.5%, almost identical to 2020's 34% decline. Investor fears over computer program trading were felt to play a major role. But the economy did well throughout 1987, with increasing GNP, a decreasing unemployment rate, and moderate inflation. Likewise, the 2020 economy was also fundamentally strong. It was only the self-inflicted pain of the lockdowns and supply chain disruptions that brought the market to its knees. In these cases, the downward spiral, while generating understandable fear, tends to be short-lived. The 1987 decline lasted less than 2 months, with most of the damage, 22%, being done on a single day. The 2020 crash took only 5 weeks. The lesson, therefore, is to sit tight with a sound portfolio. It is only when you discover signs of deep-rooted or systemic weakness throughout the economy that you should consider exiting the market. Even then, exiting the market is often unwise. Does the market help us recognize these signs? It does, but that is the topic for a future video. Next up, we look at an emotion that may be thought of as a weak sister to fear, and yet may be responsible for even greater losses, and that emotion is anxiety. See you then.